10 a.m. is right here, this white candle. Okay, so the way this works is you see the candle all the way to the right. That's where my trigger candle was, the way I have this set up. The way I have it set up is the market only sets up 4 different ways on each chart. And I have rules set up for each and every way. So now I can trade every day. Okay. And if I get stopped out, I have a way to get back in. Okay. So those yellow lines are standard deviations of the 10-point stop loss. You see that at the top right here? That's 10 points from this candle's open. That bullish candle that you see to the right, that was my trigger candle. So instead of going short right at the open of this bullish candle, all the candle all the way to the right of the chart, I set up into standard deviations. 25% is here, 50% is here, 75% is there, and then the top of the thing is 10 points. But I actually came to the market late. So usually I would go short on this model. So when I got to the market, price was like up here. And I saw the price action and the trend was up. I said, most likely it's probably going to take that stop loss up there. So I didn't even get in short, because usually I would have been in drawdown right now, because usually I would have went short. Let me tell you what I would have usually did if I came to the market. I would have been short right here. So I would have been short in drawdown. Then when the market came up a little bit more, I would have went short again, because what I'm doing is I'm breaking up. I'm limiting my risk, because instead of just going short right at the open of the candle that you see all the way to the right of the chart, this last candle right there, instead of going short on the close, when it closed right there, the bullish candle, let me spread these candles out. Maybe you can see it a little better. Instead of going short at that candle you see all the way to the right, I set up its standard deviations. Now I didn't go short, but that's usually how I would have done it. Okay. But I got to the market when this candle was forming, because I got late because I was trying to fix one of my devices, and I'm like, fuck it, let me just do it off my phone. I already got the rules set up. So, I mean, I'm still going to win, basically. That's what I was thinking. So I had to do it off the phone today. So usually I would have went short there and I would have went short here. But I said, you know what, based on the candle pushing down right there, the one you see all the way to the right, that bearish candle, I said it couldn't even go all the way down and give me my 14 points, because you see the little box at the bottom? See the box all the way at the bottom? That's 14 points, that white box. Because on average, when I look back the last 3 to 5 years, when this setup happened after 10 a.m., I'm not going to say exactly what it is, but it's a certain setup. It only sets up 4 different ways. Thank God I understand that now. Thank God for that. So when it do set up, I have rules around exactly what's going to happen. This is based on years of data. This is not guessing or anything. So what I did was I said, we're going to go ahead and wait. Let's go ahead and wait and see. I think that stop up there going to get hit. That's what I was thinking. So I said, I'm just going to go ahead and wait. And if that stop gets hit, then I'm going to go ahead and get in on a buy stop up 8 points. Because you see the box at the top? That's 8 points from the stop loss of 10 right there. Because when I did the testing, the back testing, it said that I can go up about 8 to 15 points. So you see how the price just broke that big bullish candle. As soon as it went up there about a tick or two, I kind of got in too early. That was kind of gambling. I should have just waited until it went right above the 10 points. But the candle was so huge, I'm like, I'm going to go ahead and get in. So I got in on a buy stop. And so it got me in on a buy. And then I bought it all the way up to, I got in on 2 positions. And I bought it up to the 8 points, which is that box up there. And then I did what ICT teaches, which is called riding the lightning. Now, as far as the structure, we had a 1 hour wick gap right there, meaning that this wick was open right here on a 1 hour chart. See that green? That's a wick gap. The market look at wicks as gaps. So I understand the structure. I'm not just following patterns here, because I know somebody going to try to say I'm that person who don't know shit, who didn't take time to, because it take a lot of time to really understand it. I'm not saying you got to do that. But, you know, I wanted to be able to talk to people a certain way, look them in their eyes with conviction that I understand this shit. I want to be a master or close to it. Okay, as far as market structure, not just lower lows and higher lows and all that shit. I'm talking about the way ICT teach it. Okay, the PhD level shit. Anyway, so this is a 1 hour wick gap, meaning that it was a bearish wick on a 1 hour chart that was open. And I understand that I marked this up yesterday. So I like to leave the markups on there for a day or two just so I can see the structure play out on my own. And so I thought it would go up to consequent encroachment, which is 50% of that wick, that dotted line up there, but it failed. Based on market structure, it was supposed to go up there. So I got out at that 10 points right there, or the 8-point line, and then its price just kept shooting up. I got out around here. I thought it would go up to the wick gap, and then price started shooting down. I got out there. So that's the whole point, is I got the money back. If I would have got in short, I would have basically broke even or made a small profit if I would have did my normal, because this is a bearish model, but if it breaks that 10-point stop loss, and that lets me know I was wrong, but then I have it where I can get back in and get the money back that I lost. That's what I'm trying to explain to people. Like, what the hell are you worried about your stop loss getting hit? Why don't you do the goddamn work and back test and see how far up this price go on average after it takes your stop loss? Because if that's true, then you can hop back in. I'm talking about, you got to have days, you got to have 20, 30, 40, 60 days or more of data that says if it breaks 10 points, it's going to go up 17. And then you back test and forward test and you see like, damn, that's true. Some days it go 30 points, some days it go 55 points. But the lowest it's ever went up was 17 points. So if you get stopped out for 10, you're getting back 17. That means you're getting back your 10 points that you lost plus 7 points. Profit. Thanks for watching.